Okay, let's unpack this. Today on the Deep Dive, our mission is, well, it's to cut through a mountain of fresh global economic data and really trying to uncover a central mystery. Are the world's major economies still marching in sync? Or are we seeing a significant divergence?
Yeah, different paths, maybe.
Exactly. Each facing its own unique battle with inflation, growth, policy choices. We're going to distill the very latest on inflation, unemployment, industrial output, central bank decisions.
All the big ones.
Right. Honing in on the US, Europe, and Japan to give you a clearer picture of what this all might mean for your understanding of the global economy.
That's a critical mission, host. And what's truly compelling here is how interconnected these indicators are, yet sometimes, well, how they present incredibly mixed signals.
Right.
We'll be looking at how recent reports from the US, UK, Germany, Japan, how they're painting this complex tapestry of where the global economy stands, and maybe more importantly, what those threads imply for us all.
Okay, let's jump right into the latest U.S. inflation numbers, which just came out because they really set the tone, I think.
Definitely.
The Consumer Price Index for all urban consumers, the CPIU, it increased 0.4% on a seasonally adjusted basis in August 2025. Now, that's a notable acceleration from the 0.2% rise we saw in July.
It is. Bit of a bump.
And looking year over year, the All Items Index is now up 2.9%. That's also accelerating from 2.7% in July. So headline numbers are ticking up.
They are.
What's driving this bump? Where are we seeing the most stubborn pressures?
Well, what's truly insightful here, I think, is that this isn't just about those headline numbers. It's the persistence in core inflation specifically. That's a key concern.
Okay.
If we dig into the components, shelter costs were, once again, the largest factor in that monthly increase. They rose 0.4%.
Still shelter.
Still shelter, and now up 3.6% year over year. That's a structural rigidity, that's proving incredibly sticky.
Right.
Food prices also saw a significant jump, 0.5% in August. Food at home up 0.6, food away from home up 0.3 for the month.
Wow.
But even the all items less food and energy index, what we call core inflation, that rose 0.3% in August, mirroring its July increase.
Steady pressure there.
Exactly. And it's up 3.1% over the last 12 months. This insistent core pressure, it really suggests we're dealing with deeper inflation forces. Forces that monetary policy, which is, traditionally a blunt instrument,
Right.
finds increasingly difficult to dislodge without maybe risking a sharper slowdown elsewhere. It's that central bank tightrope walk, isn't it?
It really sounds like it. That stickiness definitely seems concentrated in those core components.
Well,
Were there any surprising movers within those categories, though? Or maybe something that offered a bit of a counter-narrative?
absolutely, yeah. While energy overall was up 0.7% for the month, driven by gasoline's 1.9% surge.
Okay.
Natural gas actually decreased 1.6% month over month,
Oh, interesting.
which is a fascinating internal dynamic within energy, right? Although annually, natural gas is surprisingly up 13.8% year over year,
Wow.
which contrasts sharply with gasoline being down 6.6% year over year.
Strange split.
It is. Beyond that, we saw airline fares jump 5.9% month over month. Used cars and trucks up 1.8%, apparel up 0.5%.
Okay.
The only really notable decrease was in medical care services, down 0.2%. So what we're seeing is this very granular battle against inflation. Some sectors showing resilience, others still passing through higher costs.
Got it. And it's not just consumers feeling it at the checkout, right? Producer prices, reported just yesterday, September 10. They tell an interesting, maybe more nuanced story.
Yes, nuance is the word.
The Producer Price Index for final demand actually edged down 0.1% in August, seasonally adjusted. That's after a big 0.7% jump in July.
Right.
So that sounds like, well, on the surface, maybe a bit of relief. But what's the real nuance here for the broader economy?
That's a key detail, and it's easily misinterpreted. The August PPI decrease, it was primarily attributable to a 0.2% decline in prices for final demand services.
Okay, services.
Specifically, a pretty substantial 1.7% drop in what they call margins for final demand trade services.
Wait, what does that mean exactly?
Well, to put it in simpler terms, think about the profit margins businesses make from the services involved in moving goods around.
Okay. Logistics.
Exactly. Like the fees wholesalers charge for distributing machinery or vehicles, it suggests a squeeze on that logistics and distribution side. Maybe some pricing power is waning there.
I see.
However, even with that dip in services, prices for final demand goods still inched up 0.1%.
Okay.
And importantly, if we look at final demand, less foods, energy, and trade services, kind of a core PPI measure that rose 0.3%. For the fourth consecutive month,
Wow, fourth month.
yeah, standing at 2.8% year over year. This really suggests that underlying price pressures are continuing in certain core manufacturing and service areas, even as those broader trade services saw a dip. It's definitely not a universal cooling.
So even with that headline dip, underlying pressures still simmering.
You got it.
Okay, let's shift gears to the job front. That delivered some truly unexpected news this week.
Yeah, this was a surprise.
The latest unemployment insurance weekly claims data, released yesterday, September 11th. They show an advance figure for seasonally adjusted initial claims reaching 263,000 for the week ending September 6th. Now, this is an increase of 27,000 from the previous week's revised level, and it's the highest level for initial claims since way back in October 2021.
It's a long
A
time.
really unexpected jump, especially when we've been hearing so much about labor market resilience.
Yeah.
What specifically do those state-level layoffs tell us? Where are the vulnerabilities?
This really raises an important question, doesn't it, about the underlying health, maybe the fragilities of the labor market. While the insured unemployment rate did remain stable at 1.3% for the week ending August 30,
Okay.
this spike in initial claims is a leading indicator, often hints at future trends.
Makes sense.
And if you dive into the specifics, states like Tennessee saw large increases in claims due to layoffs in manufacturing. That signals sector-specific distress.
Manufacturing again.
Yeah. New York also reported significant layoffs across transportation, warehousing, construction, and even entertainment. So this isn't just a random blip. These are concentrated areas feeling the pinch.
I see.
Conversely, Kentucky saw a large decrease, also due to manufacturing, which just highlights the regional and sector-specific variability,
Yeah, absolutely.
So while the overall insured rate holds steady, these initial claims suggest specific parts of the economy are certainly facing significant headwinds. Makes us wonder if this is the start of a broader softening.
That concentration in specific sectors is definitely something to watch. Okay, let's move across the Atlantic now. We have new inflation data from Germany and a monetary policy update from the European Central Bank.
Right, ECB day.
According to our input sources, Germany's inflation rate in August 2025, it edged up to 2.2% year on year.
A slight tick up.
Yeah, just slight, from 2.0% in both July and June. But it's the first time we've seen inflation tick up there this year. What's behind this shift in Europe's largest economy?
Well, what's fascinating here is that while food prices accelerated, rising 2.5% year on year in August, and some items like fruits were up 7.1%, sugar and jam up 6.9%.
Wow.
The decline in energy prices actually slowed considerably. Natural gas, for example, was slightly more expensive, up 0.7% than a year earlier.
Interesting.
Even though overall energy prices were still down 2.4% year over year, core inflation, excluding food and energy, that remained stable at 2.7%.
Okay.
And services prices saw a 3.1% year over year increase. Passenger transport up a lot, 11.1%. Net rents up 2.0%. So it's a mixed picture.
Definitely sounds mixed.
And against this backdrop, the ECB Governing Council, as reported on September 11, they decided to keep the three key ECB interest rates unchanged.
Holding steady.
Yeah. Deposit facility at 2.00%, main refinancing at 2.15%, marginal lending at 2.40%. Their latest projections see headline inflation around their 2% target, averaging 2.1% in 2025, declining after that. Core inflation projected at 2.4% in 2025.
Okay.
So it reflects a very data-dependent, cautious stance, acknowledging these mixed signals, not pre-committing to future rate paths. It's really a waiting game for them right now.
A very cautious hold from the ECB then, even with that slight uptick in German inflation. Okay, now for the UK. The latest GDP estimate, released yesterday, September 12th, it tells us that real gross domestic product showed no growth in July 2025.
Flat.
That's after 0.4% growth in June. And over the 3 months to July, GDP grew by just 0.2%. That's quite a slowdown. What's truly going on in the UK economy, especially compared to their European neighbors?
Yeah, this is where it gets really interesting for anyone following the UK economy. The slowdown is quite evident, and it does contrast with some of the resilience we've maybe seen elsewhere.
Right.
While services output, which is a huge part of the UK economy,
Right.
it saw a modest increase of 0.4% in the 3 months to July.
Yeah.
And construction was up 0.6%. The production sector actually fell by a significant 1.3% over that same period. Yeah. Manufacturing specifically saw a 1.1% decline over the 3 months and a 1.3% fall in July alone.
So dragging things down.
Definitely. This mixed bag suggests a highly cautious economic environment. Services offering some maybe fragile support, but industrial output, particularly manufacturing, facing substantial headwinds.
What do you think that is?
Well, it could be a confluence of factors, weaker global demand, maybe ongoing supply chain adjustments hitting them harder. Even compared to a year ago, GDP in July 2025 was 1.4% higher. But this recent monthly stagnation,
Right.
it really points to underlying weaknesses and a clear loss of momentum. The big question is how long services can carry the load there.
A clear picture of stagnation in the UK.
Yeah.
Okay, let's shift our gaze to Asia now, to Japan. We have updates on their GDP and industrial production that present a bit of a divergence.
Yeah, a different story again.
According to our input sources, Japan's Q2 2025 real GDP showed a healthy 0.5% quarter-on-quarter growth. Nominal GDP up a robust 1.6%. Pretty good.
Solid numbers, yeah.
However, industrial production for July 2025, released today, fell by 1.2% month-on-month. What does this divergence tell us about Japan's economic recovery? And what sectors are driving these contrasting figures?
This really highlights the dynamic and sometimes contradictory nature of global economic recovery, doesn't it? And potential shifts in global demand.
You seem so.
While the Q2 GDP shows clear resilience, particularly that stronger nominal growth, which often reflects rising prices, maybe a healthier demand environment.
Right.
The industrial production decline is a notable concern. And if you delve into the details, it was particularly pronounced in sectors like the automobile industry.
Oh, really?
Yeah, a sharp 6.7% month-on-month decrease. And production machinery, down 6.3% month-on-month.
Big drops.
Huge. This suggests that global trade and supply chain dynamics are still playing a significant role. Maybe softer export demand or ongoing supply disruptions affecting key manufacturing components.
Makes sense.
But conversely, industries like chemicals saw a healthy 4.9% month-on-month increase. Electronic parts and devices were up 2.7% month-on-month, so pockets of strength exist.
Okay.
We should pay close attention to how these production trends, especially in export-driven sectors like autos, impact Japan's future growth and what it implies for the broader global supply chain, too.
That's a fascinating look at how different sectors are behaving, even within a resilient economy. Okay, now let's look at how the financial markets are digesting all this, as seen in the provided data from finviz.com.
Right, the market reaction.
Yesterday, September 12th, NASDAQ actually notched a record high close. Yet the Dow slipped, and the S&P 500 had a winning week overall. But all this happened even as bond yields rose and consumer sentiment weakened.
Yeah, quite the mix.
What's particularly striking about this mixed market picture? What's causing this kind of selective investor behavior?
This truly is a fascinating divergence. It really underscores a selective market, right? Rather than a universally confident one.
Seems that way.
While the NASDAQ continues to be driven by certain sectors, probably tech and growth,
Likely.
the broader market isn't entirely following suit. We saw 66.2% of stocks declining yesterday, compared to only 30% advancing. That points to pretty narrow market leadership.
Right.
And the weaker University of Michigan consumer sentiment data for September, coming in at 55.4 against an expected 59.2.
A miss.
A definite miss. It suggests a palpable disconnect between these market highs and the broader consumer mood. Futures also reflected this caution today. Dow, S&P 500, NASDAQ 100 futures all down. And when we see rising bond yields like the 10-year Treasury up 1.25%, the 5-year up 1.31%, 30-year up 0.60%, that can signal investor concerns about persistent inflation or the rising cost of borrowing,
Sure.
which can ultimately create stock buyer fatigue, as some headlines were suggesting.
Right.
It's almost like the market is having a personality crisis, different segments telling very different stories.
That analogy of a personality crisis perfectly captures the current mood, I think.
Yeah.
So given this backdrop, how are the currency markets reflecting these global shifts? We're looking specifically at Euro-USD and USD-JPY today.
Well, the USD is largely unchanged, up just 0.01% as of yesterday.
Flat.
Pretty flat. This suggests the market largely anticipated the ECB's hold, or maybe the German inflation print offset other factors. It tells us there wasn't really a strong directional conviction there.
Oh.
For USD-JPY, we're seeing a 0.30% increase for the US dollar.
Dollar strength there.
Yeah. This could be influenced by a combination of factors. The recent U.S. economic data, which still shows some underlying strength despite cracks, And those Japanese industrial production figures we just discussed, highlighting some weaknesses in their export sectors.
Makes sense.
The crucial point these figures bring into focus is how upcoming central bank meetings, particularly the Bank of Japan's next week, will influence these pairs as this whole global picture keeps unfolding.
That's a good setup for what's coming. But before we get to the calendar, let's take a specific deep dive into a really compelling local anomaly. It underscores just how diverse economic forces can be.
Oh, okay.
I'm talking about natural gas prices in the Northwest U.S. According to the U.S. Energy Information Administration, prices there remain historically low in 2025.
Really low. That is surprising.
Right. Given the broader energy cost discussions we often hear, what's the story here? Why is this region such an outlier?
This is where it gets really interesting, host, because it's a very regional, very specific story. A genuine counter-narrative to general energy trends.
Okay.
The data shows that monthly average natural gas spot prices at Northwest Sumas, which is a key hub up there, reached a historic low of just $0.56 per MMBtu back in June.
56 cents.
56 cents,
Yeah.
averaging a remarkably low $1.59 through August 2025.
Incredible. Why?
Well, it's attributed to a perfect storm of factors. First, robust supply from Western Canada. British Columbia hit a record 7.8 billion cubic feet per day in July. Alberta hit a record 11.6 BCFD back in March. It's a lot to supply.
Okay, supply side covered.
Then, combined with subdued regional demand for natural gas-fired electricity. And what's fascinating is why demand is down. Higher renewable generation, like wind power, up 14%, and solar up a staggering 64% compared to the previous 5-year average,
Wow.
has significantly displaced natural gas demand. On top of that, cooler summer weather reduced air conditioning demand. For example, cooling degree days in Portland were down 38% compared to last year.
Significant.
Yeah. And to top it all off, storage facilities like Jackson Prairie in Southwest Washington, they are over 95% full as of September 7th.
Basically full.
Basically full. So it's this stark, compelling example of how regional supply and demand, alongside rapid renewable adoption and even weather patterns, can just dramatically impact local energy prices, even while national or global trends might be very different.
That's a phenomenal illustration of localized market forces. Really contrasts sharply with some of the inflationary energy pressures we discussed earlier. So what does this complex, divergent picture mean for what's coming next? Looking at the investing.com economic calendar, next week is packed. Crucial announcements that could definitely shift these narratives.
Indeed. These upcoming events are critical for all of us to keep an eye on, as they could truly shape the economic narrative going forward.
Okay, what are the highlights?
Well, on Tuesday, September 16th, we'll get the U.S. retail sales data for August. That's a fresh, vital look at consumer spending, huge driver of the U.S. economy, right? Midweek, Wednesday, September 17th, we're expecting August CPI data from both the UK and the Eurozone. More detail on inflation across Europe could influence future ECB thinking. But the really big events, they land on Thursday, September 18th. We get the U.S. FOMC statement, their economic projections, and the policy rate announcement.
The Fed decision.
Exactly. The prior rate was 4.50%. The market's expecting maybe 4.25%. That'll be followed by the press conference, crucial for forward guidance.
Always is.
Then on Friday, September 19th, the Bank of Japan releases its monetary policy statement and policy rate announcement. Expected rate there is 0.50%.
Okay.
These central bank decisions are clearly critical for you to watch, as they directly impact borrowing costs, market sentiment, currency valuations, really the whole global picture.
What a week of economic data we've just navigated. We've seen U.S. inflation ticking up, persistent core pressures, jobless claims spiking unexpectedly, mixed GDP from the U.K., solid growth but falling industrial output from Japan.
A real mix.
German inflation inching higher, the ECB holding cautiously, markets showing these interesting divergences, NASDAQ at a record, but sentiment weakening, yields rising. There's certainly a lot to digest, isn't there?
Indeed, host. After dissecting all this data, it's just so clear the global economy isn't speaking with one voice right now.
Definitely not.
We're seeing this striking divergence.
Yeah.
Resilience in Japan, stagnation in the UK, sticky but maybe localized inflation in the US and Germany, and central banks adopting vastly different stances.
Right.
The real insight here, I think, is that understanding your economic landscape means looking beyond just the headlines and identifying these regional currents, these different speeds.
Good point.
The question for us all now is, can this patchwork global economy maintain stability? Or will these divergent paths inevitably start pulling each other off course as central banks move in different directions? It truly gives us something compelling to think about.
It certainly does. Thank you for joining us on the Deep Dive. We hope this exploration helps you feel a little more well-informed and equipped to navigate these complex economic currents. Until next time.